Hello and welcome. Today, let's talk about the income tax treatment of rental income on your immovable properties. That is, if you receive rent on any residential or commercial building that you have, then we'll see whether you have to pay any tax on it, are there any deductions, and in the end, we'll see how you can save tax on these rental incomes. For the purpose of income tax, we can classify rental income into two different categories. First, rental income on residential or commercial buildings, say on house, office space and so on. The other is the rental income on vacant land, that is the land on which you have not done any construction. Rental income on residential or commercial building would be taxed under the head income from house property, and rental income from vacant land would be taxed under the head income from other sources. We'll shortly understand the difference between the two. Legal owner of the immovable property is responsible to pay income tax. Legal owner is the registered owner, that is the person in whose name the property is registered. Before we actually compute taxable rental income, let's first understand the basis of computation. First, gross annual value. This is the rent that you actually receive. This cannot be less than the fair rent. Fair rent means rent for a similar property in the same or similar area. From this gross annual value, you can reduce municipal taxes that you have actually paid. For example, in Bangalore, we pay property tax to BBMP. This can be reduced from gross annual value to arrive at net annual value. Then we have couple of deductions. First, standard deduction, which is at a flat rate of 30%. This is basically to take care of repairs and maintenance due to wear and tear and so on. Then if you have availed any housing loan, then interest that is payable on housing loan can be availed as a deduction. Once you make these adjustments, the balance would be your taxable rental income. To have a better understanding, let's consider a simple example. Let's say here is a house that you have rented out for a monthly rent of 20,000. So annual rent would be 2.4 lakh. Let's say the property tax that you have paid is 10k and interest on housing loan is 100k, that is 1 lakh. Let's now compute taxable rental income. First, gross annual value, which is 2.4 lakh here. From this, let's reduce property tax of 10k. So net annual value is 2.3 lakh. Then we have standard deduction at 30%, which is 69k here. Then interest on housing loan 1 lakh. So taxable rental income would be 61k. Now on this 61,000, you have to pay tax at the rate as per your slab. That is, if you are in 5% tax bracket, you have to pay 5% tax. If you are in 20% tax bracket, then 20% is the rate of tax and so on. If you have availed housing loan, then you need to remember two key things here. First, you can avail this deduction whether or not you have actually paid this interest to the lender. That is, on the basis of provisional interest certificate, you can avail this deduction. Second, this deduction is capped at a maximum of 2 lakh for a financial year. So if your interest liability is more than 2 lakh, then excess can be carried forward to subsequent years and you have a time limit of 8 years to set this off. To understand this better, let's consider another example. Let's say your rental income for financial year 22-23 is 3.6 lakh. Property tax that you have paid is 10k and interest on loan is 2.5 lakh. For financial year 23-24, let's project your rental income to be same, that is 3.6 lakh, property tax 10k, but your interest on loan is reduced to 1.5 lakh. Now for financial year 22-23, gross annual value would be 3.6 lakh, that is your rental income. Let's reduce property tax of 10k from this to get net annual value of 3.5 lakh. Then we have standard deduction at 30% of NAV, which is 1,05,000 here. Then we have interest on loan Actual interest for the year is 2.5 lakh, but as this is capped at a maximum of 2 lakh, interest for the year will be limited to 2 lakh. So your taxable rental income would be 45k. Now this balance 50,000 interest would be carried forward to subsequent financial year. You have a time limit of 8 years to set this off. Let's now move to financial year 23-24. Net annual value would be 3.5 lakh. Standard deduction would be same, that is 1,05,000. Interest on loan for the year would be 1.5 lakh. Then from the last year balance that we have carried forward, we are going to adjust that 50k here. So taxable rental income would be 45k. If you have rented out a vacant land, then unlike residential or commercial building, there is no concept of standard deduction here. Also, this interest on housing loan is not going to be applicable because this deduction can be claimed only after the house is constructed. So if you are renting out any vacant land, then whatever actual expense that you incur can be reduced from your rental income, and the balance would be taxed under the head income from other sources. Again, the rate of tax would be as per your slab. So to sum it up, if the rental income is on residential or commercial building, then it's going to be taxed under the head income from house property. So you can claim this standard deduction and interest on housing loan wherever applicable. But if it is a vacant land, then actual expense can be reduced from the rental income and the balance would be taxed under the head income from other sources. First, joint ownership. If your spouse is also earning income, then it is always a good idea to go for joint ownership, and if you are availing housing loan, then better to avail loan jointly. This has two benefits. First, proportionate rent would be taxable to both of you. Let's say the rental income is 2 lakh, so rental income would be 1 lakh for each of you. Second, this maximum limit of 2 lakh for interest on housing loan is per person. So if you have availed joint loan, then this deduction can go up to 4 lakh for a financial year. But you might think, what if you buy the immovable property in your name and later on gift it to your spouse or children, and once they become the registered owners, they would be required to pay tax on the rental income. But this is not going to be possible, because even though your spouse or children are going to be the registered owners, you would still be considered as the deemed owner of the property and you would be required to pay tax on rental income. So gifting of immovable property to your spouse or children is not going to help you save your taxes. 2. It is better to plan your repairs and maintenance in a staggered manner, because the standard deduction is limited to a flat rate of 30%. So if your expenditure is going to be more than this, then that's going to be a loss for you. Also, if you have major repairs, if possible, you may plan it at the end of the financial year so that you would be able to spread this expense across different financial years. 3. If you want to save taxes, do not club maintenance expenses with your rent when you prepare your rental agreement. If you live in any apartment, I'm sure you would be aware of monthly maintenance expenses that we pay. This is basically to take care of common facilities that we get. So if you are renting out any apartment, ensure that you provide breakup of this rent and maintenance expenses in the rental agreement itself. Otherwise, you would be required to pay tax on the entire money that you receive. Also, it is a good practice to let your tenant directly pay these maintenance expenses to the association. Otherwise, you would end up paying tax on something which is actually not your income. Usually, loss can be carried forward to subsequent years only when you file your income tax return within the due date. But in case of house property loss, that is the excess interest that you have to carry forward to subsequent years, you can do this even if you have not filed your income tax return within the due date. Last and the most important one, If the rent that you receive is more than 50k per month, then your tenant would be required to deduct TDS at 10% if you provide your PAN. Otherwise, the rate of TDS would be 20%. If you would like to know more about this, you may consider watching my earlier video, the link in the top right corner. So once you provide your PAN to your tenant, ensure that you declare this rental income in your income tax return. Otherwise, chances of getting notice from the income tax department is very high. That's all I have for you today. Thank you for watching.